Finovate showcases cutting-edge banking and financial technology through a global conference series featuring short-form demos and thought leadership. Now, the conversation continues on the Finovate podcast.
Hey, everybody, and welcome to the Finovate podcast. My guest this week is Zach Noorani, partner at Foundation Capital. Zach, thanks so much for taking the time to be here today.
Hey, Greg, thanks for having me.
Cool. So we're going to be talking a little bit about neobanks. Before we get there, can you give us a little bit of background on yourself and where you're coming from?
Yeah, sure. So as you mentioned, I'm a partner here at Foundation Capital. We're a 30-year-old, $6 billion under management venture firm. We're earliest investors in companies like Netflix, Sunrun, Rappi, Solana. My background, 100% of what I do is fintech investing. I spent really my whole career in financial services, the first decade of which I spent at Capital One. And there we were really building and buying our way into new business lines, diversifying beyond being a credit card issuer principally. And somewhere along the lines, I realized doing this from a small company perspective, building new products in financial services was a lot more fun and frankly a lot more lucrative. And so I've been doing that. I've been living in this fintech land since before the mortgage crisis. Actually, so goes way back. And these days, I'm an investor in companies like One Finance, which actually just sold to Hazel/Walmart, Current. Addy, buy now, pay later business down in Colombia, Highline, the list goes on and on.
No, it's really cool. And the amount of experience that you're bringing to the equation is obviously pretty substantial here. And that's why I think it's great to get your thoughts. So let's talk about, as I mentioned, we're going to talk about neobanks here. Before we get too far, I'm curious how you define that, having been in the fintech industry for so long. Are they necessarily digital only or just digital first, or does that have more to do with when they were created? How do you define the word neobank?
Yeah, I guess I accept the colloquial meaning, which is, I think people intend, digital first and really even more so mobile first. And I think importantly, DDA first, so very strictly checking account oriented. That you might add products over time, but that sort of origins there. I think more broadly, I'm remiss not to say, I struggle with startup nomenclature like this. Startups, these organisms, they evolve so quickly. Terms like neobank, at first they seem grandiose, just kind of way beyond kind of what the businesses actually are. And then before you know it, they end up feeling overly narrow and constricting. And so it's sort of, I always try to sort of not get too stuck on the labels.
Yeah, I think you're spot on there. That pattern is something I've definitely noticed as well. At first it's promising the moon, and then later on you're like, wait a minute, well, that doesn't quite describe me. Actually, we're a little bit different. So we certainly see that on the Finovate stage with some regularity. No, I'm not buy now, pay later, or whatever the case may be. It's a fair point. Obviously at a really high level, and you've been watching this space, the past 10 years, we've seen two trends kind of moving in opposite directions. There have been a lot of bank closures, consolidations, a lot of branch closures. At the same time, it seems like neobanks are popping up more and more frequently. How can you explain how both of those situations can be true at the same time?
Yeah, I can see how, the contrast seems really odd. The first piece here, the closures, the M&A, that's just what happens in mature industries, which banking absolutely is. Very unlike tech, where you see, the largest of companies in the world still growing 20, 30%. Banking, over the cycle, this grows at some factor of GDP growth. And so the closures, there are certainly some, smaller institutions going out of business, but more than anything else, the branch closures here, that's larger institutions, repositioning their branch footprints to account for, shifting population patterns, and these branches are in many cases, 30, 60 years old. The M&A is, as you say, it's really about consolidation. There are scale benefits in all kinds of ways in banking. That is to say that the bigger you are, the more likely you are to find competitive advantage. And because this is a really mature, highly competitive, and really realistically like commoditized industry, the most efficient growth path to all these, really pretty long in the tooth players is acquisitions of businesses that look exactly like theirs. And so we see lots and lots of consolidation, and have been, this is a 30-year-old trend, and I think we've got another 30 years left of it. Now, on the neobank side, what explains the growth of these animals? Well, they've found an entirely different path of efficient growth, and I characterize that as mobile first, lower or different cost structure. In some ways, it's much lower without the branches, but in other ways, that a lot of that spend really just translates to ads. And with a different revenue model, using, kind of leveraging a Durbin exemption to sort of have more lucrative debit interchange. And while it's not impossible for banks to replicate that, or many banks that are sort of below that Durbin threshold, the basis of competition here, the way that the neobanks succeed, this really the same way, for instance, an e-commerce provider would succeed in terms of, efficiently deploying ad dollars and funnel and digital funnel conversion. And for a traditional bank, that's just not something they're built to succeed at. Now, because this neobank growth path is so efficient, and the banking industry, overall is so massive, there's really been no end in sight to the amount of VC dollars and growth capital willing to fund it. And so, hence, we've seen this massive proliferation over the last half decade or so.
No, that's a really interesting point there about the capital side of it, because there is so much VC money going into the neobank space. Obviously, the traditional financial institutions don't have access to that kind of capital, and they also don't have the luxury of saying, we're going to wait 5 years to become profitable. You don't have that ability to kind of grow and really focus on the growth side and scale up in that same way. So how big of a role do you think that actually plays in kind of the differences between the two sides of the coin at this point?
Yeah, I mean, I think quite a bit, right? Like an ability to sort of pitch investors and sort of say, I have no intention of making money for almost the next decade, and yet I want you to, value my business in a way that enables me to continue to own the vast majority of it. That's really unfair advantage, kind of relative to a more traditional, in any mature industry, there's, you're going to be getting asked really hard questions about ROEs. And how quickly you can start generating those ROEs, and so the VC capital is for the moment really available to the neobank side, and that kind of like we have a lot of growth ambition, and but profitability is kind of a longer term kind of goal where on the bank side, obviously it's sort of like very little tolerance for that kind of narrative, and so it's a different story entirely.
Yeah, and then I think the other side of it too is obviously the customer side of it. What do you think neobanks are able to offer to customers that more traditional FIs maybe either aren't able or struggle to offer?
Yeah, so I think they're obviously the marketable features which the banks are catching up to as we speak. Stuff like a very slick mobile app experience, no maintenance or penalty fees for account usage, and then stuff like advances on direct deposit. And I think those have played a big role, thus far in this evolution of neobanks. But underlying that, I'd argue that it's a lot more about mobile acquisition with modern consumer brands. I'll use myself as an example. As someone who spent the vast majority of my adult life with a smartphone, and because of that, I have a base expectation that the products that I'm going to that I'm looking for, I'll find them on Instagram, that I can sign up, that I can apply, buy that product in real time on my phone. And that principally is what I'd argue neobanks are succeeding at the most, and is what someone like a Bank of America is failing to keep up with.
Yeah, no, I think that's a really good point too, because clearly, the ways that people are searching for these products, the way that they're kind of absorbing marketing is obviously shifted quite a bit. And the companies that are able to speak that language really fluently clearly have an advantage. Let's broaden out a little bit, because I think we've been kind of focused on neobanks specifically, but how is this neobank surge affecting other aspects of the banking and finance ecosystems? I mean, really, what's the ripple effect here? And we can kind of approach it from both kind of the industry side and then the consumer side, if it's easier to break it down that way.
Yeah, no, interesting question. So, on the industry side, I think the effects thus far are relatively marginal. Stuff like merchants, hotels, let's say, can now discriminate acceptance by issuer. So to say, I'm not going to accept Cash App debit cards, as a means of reserving a hotel room, because I know chargebacks are going to be drastically higher than they would be for, let's say, a Bank of America debit card, because they have those two companies have very different customer profiles. Other opportunities, for, let's say, more industrious banks to partner with the neobanks in various ways to benefit from their kind of massive acquisition engine. So maybe that means sponsor bank kind of business, or really on the asset generation side, getting access to all those customers. On the customer side, the impacts are much bigger. The first and foremost, you've got a hell of a lot of savings on penalty fees. This is obviously like a $20 to $40 billion worth of cost that gets taxed on the American consumer for kind of overdrafting your bank account, that has been removed for a neobank user. By that same token, overdrafts have a while pretty reprehensibly priced, are a huge source of short-term credit for a lot of consumers. And so, I think one ripple effect that we'll see is that demand will get served elsewhere. New forms of payday lenders in some shape or form. Now, longer term, for consumers, I think this gets really interesting. No one knows for sure, but I think this is really a story about new kinds of bundling. Maybe coming back to where we started about the nomenclature and kind of the challenges with it. For example, should a neobank help you find an auto loan? I think that an easy answer is like, of course. That's a
Sure.
core business of that's a core business of Bank of America as well. But why can't that neobank also be the tool that helps you find the right car in the first place to buy? There's no natural limit here, given that the DNA of a company like Current, let's say, this is a software company. This isn't a bank. And considering the incredible engagement, the richness of data that a primary checking account relationship holds, I think we could all end up being quite surprised by the degree of sprawl and bundling that we end up seeing here with these software companies that are sort of in the business of providing financial services.
No, that bundling one is a really interesting one. Unfortunately, we don't have time to kind of dig into that a little bit deeper today, but that's a really good one for anybody to kind of follow up on and just even sort of watch this space, as they say. But let's end by kind of zooming out even further, because this is obviously a transition point. We're in a moment where things are shifting and shifting pretty quickly. Broadly speaking, where does this end? Is there a stasis point or something like that that's visible on the horizon where we think, okay, now we'll have a new system in place?
Yeah, well, I think the first point here that I get excited about is that there isn't going to be an end to this. This is going to go on for decades. The fundamental shift of service delivery model from hyperlocal, brick and mortar to digital. This is going to take a really long time. And there will be lots of opportunity resulting. But I think to get real specific, it's really interesting to think about what happens to. I've been picking on Bank of America a lot, so we'll keep doing that. What happens to them over the next couple of decades, particularly, let's say their consumer business and consumer banking business. Right now, I'd imagine they aren't terribly worried about neobanks. They make the vast majority of their money off of older and richer customers. Neobanks haven't really touched that segment of the population yet, and that's because very few 50-year-olds with complex financial lives are really open to switching checking accounts. And so the tried and true way that that Bank of America got all these, kind of affluent 50-year-old banking customers, it's that they signed them up when they were 25, and they grew with them. They retained them, and they and enabled those individuals to sort of grow into kind of very profitable customers for them. And so, what do we know to be true today about kind of market share shifts? It's that the Bank of America's share of 25-year-old primary checking customers was probably, let's assume it to be the case, it was exactly analogous to their overall kind of deposit share of the U.S. market, 11%, 12%, let's say 5 years ago. Today, because of Chime, Current, Cash App, Vero, and the other other host of players, that's probably more like 5% and falling precipitously. And so really what we have is an effect here of as there will be blood line about milkshakes, this drink your milkshake. That's what's happening here. 20 years from now, the Bank of America's share of that 50-year-old class of customers where they make all their money, well, that's going to have collapsed. And so I think this will be a fascinating phenomenon to watch. And largely, it's this kind of thing where it's sort of already happened. It's just not yet manifested in the P&L.
Yeah, no, the rock has been thrown, but the ripples are still radiating outward, basically. It's going to be, as you say, fascinating to watch this space, because so much of how financial services is going to engage with itself over the next 20 to 30 years is being decided right now. And there are clearly forward-thinking financial institutions who are well aware of this, who are aggressively targeting this younger market, trying to shore up their futures. And there's clearly also banks and financial institutions on the other side for whom that's not the case, for whom they are just looking at this and thinking, I can run out the clock. I don't have to worry about this. But in 20 years, it won't be my problem. It'll be somebody else's problem. And I think the difference between the two groups is going to get starker and starker. And may follow in many cases, the same kind of trajectory as, the companies who 10 years ago started looking at financial technology. Some of them really jumped in. Some banks said, yes, this is the future. We need to engage here. And a lot of them said, there's nothing here that we need to worry about. We've kind of seen how that's gone. And I think you're right. We'll see something similar in this other area as well. So I've been talking with Zach Noorani, partner of Foundation Capital. Zach, thanks again for taking the time to chat with me. It's been a really fascinating conversation. And there's quite a bit for us all to keep an eye on over the next couple of years.
Thanks a ton, Greg. This was a lot of fun.
The Finovate podcast is produced by Informa Connect in association with Provoke.fm Media. Check out Finovate.com for information on Finovate's upcoming shows and to learn how you can get involved. The discount code Finovate Podcast will save you 20% on tickets to all of our events. And you can email us at info@finovate.com for information on sponsoring, speaking, or demoing. Thanks for listening.